right, we're now going to move over into a Q&A session. I'm going to start with Matt Castle and maybe to pose this to Henry. Is it as simple as when ZIRP reverses that we'll see sky-high valuation multiples also reverse?
Yeah, Matt, so I think that's a great question. And the truth is, it is a fluid situation. But I think the point we're making is that we are seeing very clear signs of excess capital at the high end of the risk curve, which is demonstrating an almost irrational or abnormal tolerance for risk. And when interest rates do ultimately start to normalize, liquidity at that end of the spectrum will start to dry up. And that puts the racier end of the market, the valuations that we're seeing there, at risk, companies that are trading at 40 to 50 times sales.
The ideal offshore allocation that investors should have in their portfolio, this is one of much debates. I think the approach that we take is to look at each individual's portfolio separately. I think for your living expenses in South Africa, we think you should have a fair chunk of SA assets. You need to cover your income out of rands and match rands with rands. And the nice thing about South Africa is you can earn high yields in South Africa. Once you've kind of covered that base and you've got kind of excess in NAV, we would encourage a fair bit to be offshore, as much as 50, 60% plus. I think importantly, there's lots of different ways to get global exposure. And just to echo the point that Nolan made, it's not just about rand dollar. As we've shown you, and it's come through in this presentation as well, there's lots of themes and companies globally that you want to be invested in, and you simply can't get exposure to that in South Africa. So in the whole tech space, it's really Naspers or nothing. We like Naspers, but we don't want all of our tech money in any one share, no matter what it is. We'd like that to be diversified. And in investing offshore, you don't have to physically take the money offshore. We've got lots of local funds which have, a high proportion of global exposure. With Biden being elected the new president of the USA, this is Henny Pepler, are you of the opinion that this will stimulate the market understanding the impact of the pandemic? Nolan, do you want to have a go at that?
That's a thorny one. I think that...
That's why you've got it, Nolan.
Thank you. So I think that in the short term, Biden's stimulus package is going to be positive for the market. We certainly expect that once this passes its way through Congress and through the House, that there is more benefit for the markets. We think that the Biden administration is going to focus on different aspects of business. For instance, renewables will probably get a big shot in the arm from what Biden is going to do. So overall, we think that that's going to be quite positive. The only potential drawback that we are slightly concerned about is Biden did campaign on higher tax rates, and obviously paying tax would be a little bit negative. That being said, given the slimness of his majority, particularly in the Senate, we don't think that he is likely to be able to pass anything too extreme. So at this stage, we think that the risks are probably skewed towards him being a more supportive president for the markets. And we've seen that of late. I think the market has continued to rally, notwithstanding his first day in office, notwithstanding his initial actions, and to be honest, bringing COVID under control in the short term and actually actioning some policies around that, again, could be hugely supportive for the market if you go back to my tug of war that I was explaining.
Right. We've got lots and lots of questions coming through. A lot of them were posed during the presentations, and I'd like to think have been answered. So we're going to try and finish this by about 9:30. I'm trying to select the questions which I don't think we raised. Nolan, again to you, a question on SA taxes. The question from Jonathan Cohn is, which taxes do you think will be raised to fund government's deficit? It kind of implies that we think taxes will be raised. Some perspectives on that?
None of them, to be honest. We have hit that point on the Laffer curve where increased taxes equals less revenue for government, because the population starts to move both their capital and their income abroad at a faster pace. So the government, from the perspective of increasing taxes, knows that it's actually going to just increase the incentives for avoidance structures. It's going to increase the incentives for people to immigrate from a tax perspective. In the short term, it might give you a short-term boost while people respond, but in the long term, it is negative. The current administration is very aware of this, and if you look back at what the finance minister was talking about in the October mini budget, basically they were saying that increased taxes are going to be, 10 to 15 billion rand. And that is actually quite easily achieved just with a little bit of bracket creep for individuals. We don't move the tax brackets around, and possibly a bit of sin taxes. So we're expecting a very light action on the tax base, notwithstanding the fact that it is budget season, and that means any analyst or commentator that wants to get his name in the press just has to put a radical idea out there, and he gets plenty of airtime. So I think we will see that come through the press. However, I think the orthodox nature of what our finance ministry has been doing will keep the tax hikes quite contained.
Okay, a question. If we're expecting 11% for the year from the local market, it's already given 8%. So why not cash in and put the money into an income fund? A very good point. In fact, we were discussing that yesterday with our projections for the year. I think our projections are very much based on fundamentals and valuations. It's very difficult to predict sentiment over a 12-month period. And when the market's had a nice run like it has this year, it's very comforting. It's great to see people making some money. But that, things can go beyond valuations, and things can get more positive for a time period. So I think we perhaps are a little bit conservative. If things do happen quickly, we don't necessarily want to take the chips off the table. What we will do is go and assess the companies that have given rise to these returns. If the market's up 8, that means some companies are up 20, 30. So perhaps take a little bit off the table. But I think the core view is staying invested, and certainly for conservative investors, if things went up another 5%, I'd be inclined to move some into our greater array of income products. Henry, one for you. Chris Ertel, what is your view on the government regulation plans for Alibaba and Tencent and the potential risks?
Yeah, so I think what you're seeing play out with Alibaba right now is more of a show of power from the Communist Party. Jack Ma was very vocal about the legacy Chinese banking system going into the anti-IPO. But the broader sort of antitrust initiative in China was put into place already in January for the reasons we discussed during the presentation. And that is these tech companies, both in the US and China, are essentially unregulated. And this regulation is necessary. And I think we discussed why. With Alibaba specifically, I think that's created a great opportunity to own the stock. It is a material position in our technology fund. In the context of the tech sector, it exhibits tremendous value. And financial is still an incredible business, and I think it will still IPO in the next 1 to 2 years. And then on Tencent, they've kept a relatively low profile. And again, the valuation looks favorable. So those are both stocks I like. And antitrust in China, for the same reasons I discussed in the presentation, is not something I'm afraid of. It certainly wouldn't deter me from investing in the space.
And then another one for you, Henry. Is Prosus just as good an investment as Naspers? I think for me, the fact that management is incentivized at the Naspers level is probably the most compelling fact. But how do you view it, Henry?
Yeah, I mean, the primary driver of those two stocks will be the performance of Tencent, and Tencent is a performance that we really like. But as you've mentioned, you've got the discount dynamic with Naspers, and management are incentivized to close that discount. So I like both, but I'd probably err towards preferring Naspers for that reason.
Nolan, with respect to our view on US inflation, a number of analysts are predicting dollar hyperinflation, not inflation in the medium term as a result of QE. And how do you think about the apparent paradox that central banks can now seemingly print enormous amounts of money without a material impact on inflation? This is really one of the core issues around, and one of the reasons I put up that inflation slide. Perhaps you want to give some perspectives, Nolan?
Thanks, Peter. And I think this is something we've been discussing since 2010 when quantitative easing started. And these analysts were running around crying hyperinflation. if anything, over the next decade, we've seen a dearth of inflation. So we haven't seen that inflation, and the question is why. A year ago at the roadshow, I was talking about the consequences of printing money and saying that one of the reasons for this is that the velocity of money has slowed down. So basically what it means is the money tends to sit in bank accounts longer. It isn't getting spent as quickly. It tends to find its way, instead of into the real economy, instead finds it into the investment portfolios. Look at the lady that Henry was talking about. So for all of these reasons, the money has tended not to spur inflation. And if anything, one would argue the inflation has firstly been in financial assets, which arguably in cases are at unrealistic levels in terms of prices. Secondly, the money, Americans have got lazy because they haven't had to work as hard to keep a big cash balance because there's just more cash around at the moment. And the combination of those factors has not led to inflation. Could that change? Yes, it could. But at the moment, I think it's reasonable to expect that the trends that we've seen for the last decade will continue, and that the latest bout of stimulus won't lead to inflation either, and instead we'll probably see a velocity of money slow down again. Rather technical response. Sorry.
Thanks, Nolan. Stefan, one for you. The view that from Gerald from Roy, the view that JSE listed stock is cheap, are we not potentially looking at a massive value trap? Should one look at where the SA economy is, with bonds coming to an end in December 2020, which is obviously past?
Yeah, thanks, Peter. It's the South African market has actually been a value trap for 5 years now. For 5 years, the South African market has actually looked to reasonable value. And it just hasn't come through. And it just points out again that you need earnings growth to keep a sustainable trend in the market. We are still of the opinion, especially in the domestic economy, that these are companies, although we have to give credit to the management teams, we have some very good management teams, but it's probably companies that currently, due to the low GDP growth, they are companies you want to date. To use instead of marry. So where we see the structural trends in the US tech, that's definitely not something we're seeing at the moment in South Africa. We're keeping a close eye, and at some point, hopefully when South Africa can get proper GDP growth, South Africa's valuation looks very attractive. But at current levels, we still think that the South African domestic market is probably more of a trading market, and one thing that you must get in and out when the rally comes through.
Right, changing tack completely. We've got companies like Etsy and C in our global equity fund and global technology funds. These are companies which gave absolutely phenomenal returns last year, and some of the best indications of the ability to, if you've got a good business model, the kind of network effects and the ability to create value in unprecedentedly short time. The way that the market is kind of justifying the valuations of these businesses is often on a DCF basis. So looking at cash flows well into the future and discounting them backwards. A question from one of the from anonymous attendee is, how does one use a DCF in companies like Etsy, C, etc., where the cash flows are so uncertain or predictable? Henry?
Such a great question.
Yesterday.
Yeah, we were. And in fact, so you still use a DCF, right? But what you have to do is you have to address what you think is the total addressable market for that business, and then assume what their terminal market share will be. And then you take that revenue and you apply a notional profit margin to it to calculate the enterprise value of the business. So it's a little bit of a guessing game, but I think you can get to a pretty good answer with some pretty good accuracy when you start referencing similar companies and similar sectors. But the key factor here is that under current circumstances, the market is willing to look forward 15 years to the point where those businesses become profitable. And Pete always makes the point that that won't always be the case. And when market conditions do eventually turn, the market won't be as forgiving, and the concept of a notional profit margin, unfortunately, won't ring with market participants as strongly as it does now. So those businesses will typically experience a lot more pain than the rest of the market when conditions turn.
Thanks, Henry. And I think an important point is on one of the slides I talked about things, everybody's priced to be a winner. So often in an industry, there'll be 10 big players and they're all forecast to have 20% market share. So it becomes increasingly important to pick the businesses that we think have the winning models. Another question, where will the Rand be in 5 years' time? So that's 7 Rand 43 on this date in 5 years' time. We can always give very specific forecasts when we're looking so far out. Jokes aside, I think if you look at Nolan's model, the PPP, if you take the currency forward at 4% per annum for 5 years, you're going to get to the kind of 18 to 19 Rand level. Nolan, I'm not sure if you're still there. I don't know if you want to. So mathematically, we will always follow our kind of fair value range. But as you've seen, it can swing either side of that for quite some time. But Nolan, maybe you want to add some perspective to how people should look at the currency from a 5-year point of view.
Peter, I think you've summed it up. The central point, the fair value of the Rand in our model will basically show depreciation of between 3 and 4% per annum. So times 5 years, 15, 20% weaker than it is now. Yeah, that's somewhere around about 18 Rand, just very quickly. In terms of where will it actually be, we've seen that the Rand is generally within about a 1 Rand range of fair value. That's where it spends most of its time. So somewhere between 17 and 19 in 5 years' time. And then at times of stress, it can be multiples of that. But a reasonable sort of guess is 17 to 19 with a big risk of being wrong. I think the point I would make on that, though, is that the policies being adopted by the Reserve Bank, and we saw they didn't cut interest rates yesterday, and the policies being adopted by our finance minister are very, very orthodox, incredibly so at the moment. And as a result of this, these policies are going to be quite inflation negative. We're going to see lower inflation. I think it's just the way the world is going to be in South Africa for a while. Partly it's a slow economy, partly it's the policies. That over the long run will sort of slow down the Rand depreciation. However, yes, the Rand is still going to depreciate against the developed market currencies.
Henry, one from Martin Lowe. Henry, great presentation. At the risk of sounding facetious, are you and we not suffering from a bit of cognitive dissonance regarding Apple?
Yeah, I guess so. I think Apple is actually one that I've gotten wrong over the last while. I actually didn't see their sort of transformation from a devices company into an ecosystem company, and they've done that quite successfully. Having said that, I think that it still exhibits a reasonable amount of value. And when Pete put up that slide earlier, showing the reason why we get excited about equities, showing some of the businesses that we're really excited about, I thought to myself, Apple should really be on there, because when you start exploring the possibilities that they have with their ecosystem going forward, it's really just one of the most incredible companies in the world. So, for example, with your watch, just the potential health business that Apple can build on top of that is amazing. And that, I don't believe, is reflected in the current valuation. So it's a stock that I like. It's not a huge weighting in our fund, but it's absolutely something that we might well upweight as the story becomes a little bit more clear.
Okay, a question from Paul Wood, which is very important. A lot of companies were saying take your money offshore. Are you saying bring a lot of it back? I think let's to be quite clear on what our view on that is. And certainly there's been some quite high profile commentators out there just saying take it all out, take it all out. We think that if you are a global investor, South Africa is 1% of the globe, and you should have material and healthy exposure to offshore, and particularly offshore equities. Offshore bonds can come into play when they can give higher yields. If you're a South African, you need to have costs in South Africa matched with rands. So, the investment opportunity that's available offshore means that offshore should be the default with additional cash that you get on board. Having said that, the currency is something which has enormous volatility. The South African rand moves on average R2.50 from the high to low every year. So when you're taking money offshore or you're adjusting your portfolio, you've got to take that into account. And when the currency is charged out to 19 to the dollar, when our fair value is 14.50, we certainly weren't encouraging people to ship their money offshore. We think a fair value for the currency is in the 14.50 to 15 range. So in externalizing capital, we think it's a fairly comfortable place to take money offshore. The question, of course, is what do you do with it? You have to be prepared to take some equity risk, and I think we've shown how we address it. So I think that's to be clear. We're not saying bring all your money back. Currencies can move in unexpected ways. We can come down to 14, but investment money is long-term money, and what we do with clients is look 5 years out what the targets are, where they want to get to, and take a long-term journey. We typically don't buy an investment instrument with a short-term perspective unless it's very clearly a trading view. I don't know if any of you guys want to add to that comment. Okay, then let's move on to Philip Goetz. Was the COVID crisis the end of the US bull market? If so, has a new bull market started since? And could it last another 3 to 4 years? What about the rest of the world? This is really crystal ball gazing. I think we've given you the views. Henry, just a short comment. We're kind of coming to the end of our time.
Yeah, so I think that's a good question. It certainly gave rise to a new bull market, that's for sure, after last year. Look, there's been a significant level of stimulus that's come into the system. And some trading conditions over the next 12 months in the US should start to normalize. So all of this bodes well for economic activity and by extension, the market. Interestingly, though, the market's got a bit of a barbell structure. So we spoke about that earlier on, where you've got a part of the market that is exhibiting a lot of relative and absolute value, but you've got another part of the market which is actually run really hard and it's looking quite hot. So at an index level, I think your return expectation over the next while should probably be fairly subdued. But if you can position yourself on the left-hand side, I think you stand a very good chance of outperforming the market. And as Pete says, I mean, the market can run a lot harder for a lot longer.
Some share-specific stuff. Stefan, some questions on Telcom and PPC. Perhaps just some short summary answers.
So perhaps just our comment on our view on Telcom at the moment. We find it quite interesting. Listen, Telcom is not a good company. Over time, its business model will come under pressure and margins will probably deteriorate over time. However, the management team has taken some real active steps to try and unlock some value. And if we do a sum of the parts type of calculation on Telcom, and we believe we're actually quite conservative, we can easily get to a 46 Rand type of target price where the market is currently trading at about 32. However, that is very much reliant on Telcom management team being able to unlock. PPC, that's a very interesting one. We quite
Stefan, just of interest, just to tell people that there's about 80 questions that have come through. I think about 10 of them have got PPC in them. So it's certainly one that people are watching quite closely.
Yeah, and it's unfortunately one that we are quite cautious on. We quite like the story of South Africa, and the African GDP or infrastructure play. They're coming off very depressed levels. However, that Zambian operation is still concerning. It does look as though they're making progress in that. However, until they are able to untangle themselves from the debt burden that they're carrying there, we believe that it is a very high risk, high return type of investment. It's a little bit too high risk, too high return for our funds at this stage. But we believe that if they are able to untangle themselves from there, the story can actually continue further, and you can actually wait for that to play out before you take on the substantial risk or the event risk of themselves being untangled from that structure.
Nolan, some continued questions on the currency. So just to be quite clear, our rand view now and 12 months out. Nolan, you're on mute.
Unmute. Sorry, I'm battling a bit with my microphone, but I think you guys figured that out by now. Our rand view on the currency 12 months out is for the rand to probably be in the range of about 14.50 to 15. That's that's a reasonable expectation in the context of what's going on in the world. Obviously, around that, you can add a wider range, which is somewhere between about 13.50 and 16. But yes, somewhere between 14.50 and 15 wouldn't surprise us. It's the most likely outcome.
Right, guys, we've got to 9:30. The scheduled time was that close. Thank you very much for all your time. There's still over 1,000 people watching the presentation, which I found quite remarkable. It's an indication of what's possible at this time in history. So thank you very much. Feel free to, we've answered, I think, a lot of the questions. Obviously, the time isn't there to answer all of them, but feel free to contact us personally and always at your service. Look forward to the next one. Thanks, guys.